When you're trading on Plus500, one of the first costs you'll notice is something called the spread. But what exactly is it? The spread is the difference between the buy price and the sell price of an instrument on the platform. Think of it as the built-in cost of entering a trade. Instead of charging you a commission on top, Plus500 earns money through this price difference. Here's a simple example. Let's say you're looking at a stock CFD and the real market price is $100. On Plus500, you might see the buy price quoted at $100.20 and the sell price at $99.80. That $0.40 gap is the spread. If you open a buy position, you'll start slightly in the negative because of that difference. The market needs to move in your favor enough to cover the spread before your trade turns profitable. Spreads can be dynamic, meaning they change depending on market conditions. In periods of high liquidity and low volatility, spreads are usually tighter. When the market is more volatile, spreads can widen to reflect the added risk. The size of the spread also varies depending on the instrument. Major forex pairs like EUR/USD often have tighter spreads, while individual stocks or cryptocurrencies can have wider ones. On Plus500, the spread is clearly shown in the details section of every instrument before you place a trade, so there are no surprises. It's not an extra fee you'll see deducted separately, it's built into the price you trade at. So, in short, the spread on Plus500 is the gap between the buy and sell price. It's the main trading cost on the platform, replacing traditional commissions, and it's something every trader should factor in when planning positions. Well, that's all for this video. I hope you found this video helpful. And if you did, make sure you give this video a super thanks by clicking on the heart icon to help support the channel. And don't forget to hit the subscribe button. We'll see you in the next one.